Geopolitics remained the central theme in the month of July, where we saw the UK election results show that the Labour Party won the majority of seats in Parliament, whereas the Conservative Party lost a meaningful number of seats. So as of today, we have a new Prime Minister in the UK, with Keir Starmer being elected the head of the Labour Party. There's been a number of changes since December 2019 in the UK, where we've had 3 Prime Ministers and 5 Chancellors in that particular period. In theory, a majority government should bring about stability, which we will closely monitor thereof. However, going forward, what we know from the manifesto is the fact that the Labour Party promises to focus on economic stability with some tough spending rules. They are looking to partner with business to boost potential growth rates. They are looking to utilize the National Wealth Fund to actually invest in jobs. Importantly, they are looking towards addressing the cost of living crisis in the housing space, building 1.5 million new homes. They are planning to devolve power across the UK, as well as implement a new deal for the working people. Heading over to the US, we see that geopolitics was the central theme there as well, where since the Trump-Biden debate, we saw the polls shift quite aggressively in favor of Trump being the primary presidential candidate to win the November elections versus what had previously been articulated in the polls. So as you can see on the slide, the support for the two widened divergently so. However, since then, we've seen that President Biden has now offered support to the current Deputy President, Kamala Harris, as the primary presidential candidate for the Democratic Party heading into the November elections. As you can see further on the slide, the polls between Trump versus Kamala Harris is now a lot closer heading into the November elections. Moving away from politics to some of the economic statistics that we saw released over the month. Focusing on the inflation dynamics, we saw that in the US, we had the first negative month-on-month inflation reading since the early days of the pandemic. This is a desirable outcome for the Fed in terms of achieving their inflation target of 2% year-on-year in the coming quarters. However, this also does indicate that there is a bit of cooling demand dynamics where the Fed will need to now strike a fine balance between economic stability as well as cooling inflation to more desirable outcomes. Moving away from inflation and focusing on some of the market occurrences during the month, a very interesting dynamic transpired over the month. We saw that the Russell 2000 meaningfully outperformed the NASDAQ over the month when we saw the markets pricing in a bit more interest rate reprieve on the horizon. So the reason for this divergence is the fact that with lower interest rates, it offers small cap companies a lot more reprieve in terms of the interest expense burden because of the fact that a large share of these companies have interest expense exceed the free cash flow. So they become more attractive from an investment opportunity set. So we saw the divergence meaningfully take place over the month, and it was exacerbated by a short squeeze in the Russell 2000, given the fact that this was an unanticipated move that had been priced by markets. And if we take a look at what happened to the broader S&P 500 in terms of drawdown characteristics, we saw that there was a lot more volatility that transpired during the month. In fact, we had the largest drawdown, daily drawdown, since December 2022, showing that there was increased volatility because of unanticipated market movements. So moving away from some of the market mechanics and focusing on the United States fiscal affairs, what we saw was that in the latest Treasury Quarterly Refunding Report that was released, there weren't many surprises in terms of the long-end issuance from a notional perspective. Also, what was interesting was the fact that there was less fiscal needs and less need to borrow compared to previous expectations for the third quarter of this year. Heading over from the United States to Japan, we saw some very interesting dynamics occur there as well. So we saw the 10-year yield in Japan move above the 1% mark, where it caused a bit of a wobbling dynamic in market. And in fact, when yield differentials between the United States and Japan, and actually Japan and the rest of the world, narrow meaningfully, it did create a bit of a reverse carry trade effect where the yen had a sudden and stark appreciation and caused turbulence in the market around the world. Moving elsewhere in Asia from Japan to China, we see that economic statistics in China are starting to falter again. Importantly, we see that GDP statistics actually surprised to the downside, coming in at 4.7% compared to Bloomberg expectations of a 5% year-on-year increase. And delving deeper into some of the statistics, you can see that there's still underlying weakness in the real estate sector in China. So going forward, ready to resurrect economic growth and create confidence in China, we need policies that address the debt-ridden property sector that can actually turn around the actual outlook from a structural perspective there. And secondly, we need policies that are targeted at the consumer that will restore confidence and see credit uptake meaningfully increase, because at the moment we're starting to see social financing indicators in China be rather weak. So policies aimed at restoring confidence, encouraging credit uptake, and structural change in China will go a long way in lifting potential growth rates.